Stocks finished the week on a high point this week, so nice little bounce, and we're going to take a look at in today's charts to see how that bounce and really this 2-day winning streak and 3 out of the last 4, how much we've bounced and what that means from a technical perspective in terms of okay, what do we expect to see next week? Have we seen enough strength in the Russell 2000, which has been weaker lately, or the Dow Industrials, which has been weaker lately? So I break all that down today and give you some things to look at from a charting standpoint. Also, we take a look at a pocket of strength in the economy that may be due to what's going on right now with the U.S. dollar. So we're going to take a look at how we might be able to trade that with today's trade example. So let's go ahead and get started. Today is Friday, March 29th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 first with the market forecast indicator. You notice we have a renewed dark green shading over here, so which means the intermediate line turned up and it's above 50. So just like that, we're back to a bullish posture again on equities, especially when combined with this being above a rising moving average. So, but you notice that moving average is slowing. There's that little curve we have going here, and it's, we had a nice, good, steep run up, and it's been slowing down. So we'll see how much we bounce off of this one compared to the last time that we bounced off of it, and the previous times where we had bounced well up above it. So, short-term sentiment did jump up higher and dipped its toe in the upper reversal zone a little bit today. Not necessarily the most bullish, but of course, unless we really drop on Monday, most likely the near-term line is going to get up in the upper reversal zone on Monday. So we'll see what happens there with that. Of course, it's a bullish posture. This is not the intermediate pullback we've been looking for still, because the intermediate line has not dropped below 50. Now remember, it has on the Russell, and the Russell, you can see we're not. If I were to go back to that weekly chart for the S&P 500 in particular here, let's go back to the S&P and go to the weekly chart. Remember, the S&P had that long upper shadow. The top of that long upper shadow, this is the same as the bottom of a lower shadow, can act as a resistance level. Obviously, the bottom of the lower shadow acting as support. So if you look at, okay, well, what is that top of that? What is the top of that long upper shadow from last week? Well, it's that high point right there. It's the high of, the 2860 on the S&P 500 that we're not quite up above yet. Remember, we already still are above these highs from late February. You look at the Russell 2000 here and go back to the daily chart. We are not above those highs from late February. It was actually a lower high point this go around than what we saw there. And again, you can see that the equivalent on that day was actually last Thursday. The high point is 1569. We're still about 30 points below that. So, the near-term line did get in the reversal zone, but we've still got a lot of room. It's taken 5 days to recover about half of what we lost last Friday on the Russell. So keep that in mind in terms of how bullish we really are right now. The Russell 2000 is telling us that that we're actually in a bearish posture. Yes, we have light green shading, but it's dark green shading that gives us a bullish posture, not light green. We actually have a red line because the moving average had declined, let's see, from 37 to 19. So it's actually still going to be red on Monday, depending upon what happens Monday and where we trade above it. It's still going to be red on Monday. So despite this little bounce up to a really low level still, 30th percentile, it's when it gets above 50 that you're bullish. So wouldn't put a lot of stock yet into that bullishness. And really, I wouldn't put a lot of stock yet into this bullishness. And how much we expect to bounce off of this. I don't think necessarily that we'll be too bullish, that we're still going to get this pullback. But the nice thing is, this pullback is not looking like this, right, which is what would concern a lot of people. The more it looks really boring and looks more like this, the better, right? Because then that means we'll set the low point, we'll bounce, and then we'll get another multi-month run out of it, similar to the one that we have that we've currently had setting into it. The Dow Jones Industrial Average, again, the high point from last Thursday was 26,000 conveniently, and we're obviously still above that. But you notice that it will turn green. The line will turn green, and we do have dark green shading. So like the S&P, like the the NASDAQ composite, we do have that bullish combination of dark green shading and dark green line. The only one we don't have it on is the Russell 2000, which has light green shading and a dark red line. So keep that in mind. That's, we're not out of the woods yet here. I don't think that this is the pullback that sparks a new multi-month rally. I still think we are in the midst of a pullback, and we're just kind of getting some choppiness, some up and down choppiness as we're doing this. Again, according to what the small cap index has been telling us. Alright, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, there's a subscribe button down below the video. Click on that. That will notify you when we post these videos on YouTube. Also, click the thumbs up icon that's down below the video. That tells us two things. Number one, you got something out of the video today. Number two, you want us to do the video again Monday. Quick, easy way to give us feedback. If you're watching it and you like it, just click that thumbs up to let us know. Also, while you're down there, comment. What stood out to you in today's video? Let us know by commenting down there. What did you get out of it? What did you learn? Join our daily market outlook email list. There's a link popping out in the top right corner of your screen up there. Click that link. Very easy way to subscribe. Follow me on Twitter for more content in between videos from day to day, and join our market outlook community that we created on Facebook. You can also join our Market Outlook email list down here at the bottom below the video. So if you're on our blog, you go below the video, there's a quick little easy sign up form, just first name, last name. Remember, when you get the email list, it will have a link to the videos as well as a timestamp summary that you can click on that will take you to these segments, these specific segments in the video. And then if you scroll all the way to the bottom, you'll get the daily overbought and oversold lists. Market of clusters in the S&P 500. Remember, today's actually has the daily and the weeklies since we're at the end of the week. And technically, actually, you know what? Before I send it out, I'll add the monthlies as well, since this is the last trading day of the month. Usually, we don't have any of those, but if we do, I'll add them on to the list. So remember, you have to scroll down to the very bottom to get that, to get those lists. Back here on the blog, hit these three things. Number one, hit this heart. That will open up today's Market Outlook tweet. Click on that like button right there. Number two, hit this image that will take you to today's Market Outlook Facebook post. Go ahead and like and share that post as well, and then click on that like button. Again, those three clicks, another way to tell us really easily right now while you're watching the video that you like the video, that you want us to do it again. There's really no other way. We don't give you a survey, so there's no other way for us to see how well you like these videos beyond just those really simple and easy clicks. That's why we ask for them every day. Alright, back to the charts, and let's go take a look at the long-term view for the S&P. You can see we're still above rising 50-day and 200-day moving averages. The golden cross without really a good test of the 200-day moving average yet. Interesting to see how we're kind of coming up on this line that was initially drawn, and then we had that spike, and then the crazy, next spike, the divergent spike, and then the crash down, right? So we'll see if that ends up holding or not. One thing I do find interesting is this Hakinyashi candle. As bullish as this week has been, it is a transition candle again. So, and you see the open and the close very, very close to each other. 2800 the open, 2812 is the close. So your open next week will be 2806. Right now we're trading at 2834. So we'll have a little bit of a body, assuming that we open up there. We'll have a little bit of a body next week, and again, getting back below 2806 would give us that lower shadow and another transition candle. So that's something to keep an eye on. And again, is that possible we can get to below 2806 this week? Well, yeah, the low this week was 2785. So considering it's very, very possible that we can get another transition, if not, depending upon where we open, more of a bearish candle here. So we'll keep our eyes on that Hakinyashi. It's intended to slow down, smooth out a lot of the noise, and we've definitely been getting some pretty noisy weeks here on the regular candle, some ups and downs, some big ups and downs. But you can see again what the Hakinyashi tells us is all that noise is really transition. And we would expect a few bearish candles to come out of that transition, potentially to retest that 200, if not get close to it and then bounce and then continue to move forward on this new trend throughout the rest of this year, this 2019 year. Let's take a look at the 3 green arrow charts. Of course, we got we got two green arrows. MACD is close to getting back up above, and when you look at the lines themselves, the 8 and 17 are still bullish. We're still above the 8. They're all rising. The MACD is still above 0. Stochastic still above 50. So very bullish patterns on all of these. What we don't have the bullish patterns on is the Russell. But we are testing that 17-day moving average. The 8's not crossed above the 17 yet, so we don't have the MACD's above 0, and the MACD is still below its moving average, so no green arrow there, and the stochastics is still below 50. So we're not bullish on this pattern. As bouncy as we have been, we're not bullish yet, and we haven't really replicated that weakness yet in the large cap indexes, especially in the Nasdaq. Right, that Nasdaq has just been so bullish, well up above, and still showing very similar patterns to what we're seeing on SPX. If I take a look really quickly back to the long-term charts and look at those trend strength indicators, again, as of this week, we still don't have a bullish trend yet. Again, look at it in the big picture. Don't just look at these weeks here, but look at this big picture. We don't look like we're poised for this kind of run yet, right, which would lead to a strong bullish posture here. So we'd have to kind of break through a lot of this noise and a lot of this mess. In fact, if it wasn't for this last week, if it wasn't for this last kind of drop-off week post FOMC, where they raised interest rates that last time and had a really hawkish tone at their press conference, and the market really did not like and sold off dramatically for like 4 days, right? But then obviously we bounced right back, so it didn't. It was really policy error according to the markets. We bounced right back. So if it wasn't for that, if they had, let's say they held rates steady on that day, and we kind of bounced off of it from there to get to this point, instead of taking that 1 week dip and then recovering for a few weeks, a lot of people would be looking at a head and shoulders top right now on the markets, with that peak coming off of that middle peak and forming a lower. So again, that's why you look at this and say, okay, how come it's not showing a strong bullish trend when on the daily chart it is? It's really showing a strong bullish posture. Now keep in mind, for some context on here, let's go back to a daily chart. If you look at these lines, if it wasn't for these kind of like really strong intermediate runs that we had in 16, 17, and then 17, 18, where we had the typical intermediate runs at 1 to 3 months. Here was this we should have kind of dipped in this area here, but we didn't. We went up another month, and that was like that 4th extra month, and created that volatility. And then here we went up a 4th and then a 5th extra month and really pushed these lines up. But if I were to draw a horizontal line right now, the trend quality index, the strength of this daily trend that we're on, is about as high as we typically get without extending beyond the norm and getting up to, like I said, the 4th and 5th extra months on a trend that we normally don't get. So, and you can see the noise balance has been strong for a while. Again, similar, not to these, because these were extra. This was an extra 2 months, and that was an extra month of what we normally get on average. But if you look at this move compared to others, especially similar to this move here, we're getting pretty close to running out of gas in terms of this current intermediate run that we're on. And this is just another sign that again, doesn't mean it will fall over tomorrow or Tuesday, but it does mean that, and if this is the kind of weakness we get, see that weakness wasn't really too bearish either over here. And we can very well get something similar to this before we lead up to another run into what was a bullish year that year, coming off of that low point early in the year. Finally, looking at the intraday charts, you can see we are trading. We did get up to a higher high and a higher low. We gapped up and held up, which is different than what we've seen all week. We've gapped up and then moved down on intraday basis. So it's good to get a gap up and held up and closed really above all of this week's high. So we closed at the high of the week. Even though we've had some progressively lower volume, but that's okay. That's normal. In fact, if you look at today's volume and trading range, you remember there was a little bit of a gap here. What was it? We closed at 280.71, the low point at 281.74. So about a quarter point gap, a little bit more than a quarter point gap. So you're looking at just over 2 point of a range when you include the gap there, and the volume at 82 million, so a little bit above the average. So when you put that into context, here. 2-point, just more than 2-point range is down here at the bottom, so well below average, and the volume was just slightly right at average. So again, you know, very good. So like I said, if this is the pullback, this is how we like pullbacks to look like, right? They're not gonna, you know, they're not gonna feel uncomfortable. You know, the world's not gonna end. The perma bears aren't gonna come out in full force. And if they do, you know, I'll see them, and they usually respond to, you know, our YouTube comments or Twitter, and usually that's a very good sign for stocks in terms of whether they're going to go up or not when I do see those. But you know, that's the kind of bullish pullback that we get when we get just an intermediate pullback that leads to a new bounce. It's when you get the sharp drops just out of nowhere. Those are the kind of things we don't want to see, and we're not getting that, and we're not. You know, even with volatility where it's at right now, it doesn't look like we are going to get that volatility at 13.5, and it's not at extreme lows. You notice we're in the bullish territory, but we're not below 80 where we're worried about extremes. One little concern, just a little, but not, you know, it's not as big because we did have a jump up in volatility here earlier this month. But you notice. So last month the range was only 4 for the volatility. Last month the range was only 4.5, well, less than 4.5 points. That was a little bit of a concern. That's a really low number. Now it didn't, because you can see over here it was 4.5 points in September, right before we had that decline. That's a really low number. We didn't, you know, combine that with an extreme low like we did in September. You know, again, so you know, and heading in September, heading in October, the storm clouds were there. And we kind of have some rain clouds, not necessarily, you know, really big storms, but heading into this month, there was a little bit of some rain clouds on the horizon, and it led to a little bit more volatility. The range was 6 points, but even that's not too big. So you know, don't be surprised if we don't get a little bit more volatility in April than what we've seen these past 2 months, where it wasn't really very much at all. All right, so what do you think about that outlook? There's a link popping out in the top right corner of your screen. Click that link. It opens up a poll. Then vote. Either vote agree or disagree with what we just talked about with this outlook that we've concluded. If you click disagree, which is perfectly fine, scroll to the comment section below. I'd love to hear from you. What are you seeing? Everybody's got their opinions, right? But what I would love if you would share what you're seeing that would suggest a disagreement, right, of the market outlook that we've come up with here from our daily routine today. All right, now let's transition to what's driving the price action. We'll take a look at how these different asset classes performed here this week. So let's go to 325 right there, and we'll go to 10 months. So you can see it was a good week for risk appetite, right? Small cap stocks did very well this week, up 2.25%. Crude oil was up and down, but eventually ended up over 2%. Emerging markets bounced up and outperformed just slightly at the S&P 500. On the other end of the spectrum, the dollar was really strong, relatively speaking. The dollar had a nice, good week. That put pressure on gold. Interestingly enough, did not pressure emerging markets. Emerging markets had a really good day today. They were pressured for most of the week, and then they rallied today. In fact, if I just look at today, you can kind of see what happened here. Here we go. There's emerging markets really rallied up sharply along with crude oil. The dollar was relatively flat, and gold started strong with early weakness in the dollar and then pulled back as the dollar strengthened a little bit. And of course, small caps, which had performed well most of the week, giving back some of those relative strength and relative gains late. So, you know, it was a really good week for risk appetite, a nice little bounce in some of these areas, especially in the emerging markets. We had a really good class in portfolio management yesterday where we really dove into the emerging markets and the opportunities that it might be providing according to our expectations, according to its relative strength patterns. So we kind of dove into that and dove into like what are these areas over here. You know, from the foreign market standpoint, we can expect to do well. You can see the higher beta names did well today, but we looked to see, okay, well, where should we position ourselves in our class portfolio with what we expect emerging markets might be doing with the relative strength that it's showing. So, and the expectations really, because it's going to be highly dependent upon let's bring up the trend quality. It's going to be highly dependent upon what the dollar does. And you can see the dollar has been very noisy too. There's no trend right now in the long-term chart. If you look at it on a daily chart, same thing. No trend. We're not above 50. We are positive on this one, which suggests more of a bullish bias, but we're not breaking out yet. All right, and once we break out, that's when we get to move higher in either one of these indicators. And so we haven't really got that. It's a very, very, that if you look at the market forecast for the dollar index, you can see we have dark green shading and a green line. It is pretty darn flat, about as flat as a rising. I mean, we're out to the thousandths plate if you look under that D up there. The dollar index is 96.651, 96.658. So, that's how much it's rising, and that's why it's green. So, take a grain of salt on that, because you also see it too on the 3 green arrow chart here. We got 3 green arrows and a moving and a slightly rising moving average there. If I take a look at the Bollinger Bands here for UUP, and you can really see the sideways action and the volume there on this ETF. I mean, this is why breaking out above this area would be a 26 plus on the ETF would be so bullish, and why on any drop it holds up really well, because look at all the volume that's down below. So it's not going to tank here, and if it breaks out, it's got some potential. Even from a long-term chart, you notice there's some potential for a really good run on the dollar, and that would change a lot of people's narratives heading into the end of the year in terms of expectations, because I think commodities and weak dollar has been a common thing, and that might not be the case, and that might actually pressure stocks if we were to break out, because if we break out, there's a good chance we'll break out for a while. And that's why it's very important to keep an eye on these Brexit issues. Even if you don't trade these spot currency contracts, they are dollar related, right? So the dollar is a component here. And if you take a look again, at these trend quality indicators for the pound US dollar, you can see we did have a nice bullish trend for the pound. That's for the pound, right? So that would be bearish for the dollar, but we've now since lost that in the last couple of days, and now we don't have one at all. And if you take a look at the long-term view, same thing. In fact, we have been trying to get bullish here, but then this week has been a bad week with the Brexit. So it's very important to watch that, because if the pound and the euro stay weak and weaken even more, then because the euro is on a strong bearish trend right now, long-term strong bearish trend, if they continue weaken more, then that will be bullish for the dollar no matter what we do here. Because obviously the rate hike odds are not, there's no rate hike odds, right? They're all rate cut odds. That's not bullish typically for the dollar. Then you look at inflation expectations here, and you can see we're down as of yesterday. As of yesterday, we're down to 1.94%. That's not bullish for the dollar either. So when you look, from our standpoint, the dollar shouldn't be bullish. But if things are more bearish in Europe and in Japan, then that's bullish for the dollar. And you'll notice here we have really negative numbers for economic indicators in the U.S. And now next week is a really important week for global economic indicators. So we'll kind of keep our eyes on that, how it impacts those currencies, how it impacts secondarily the dollar, and then the impact that that's going to have on what we expect to see here in the U.S., right? And with the S&P 500. A strong dollar may actually initially put some pressure, because remember, all these stocks are priced in dollars. So barring a strong economy or slowing earnings growth and slowing economic numbers, if we have a strengthening dollar too, it won't necessarily push stocks down, but it can definitely put pressure, act as a headwind for stocks. Now, if you take a look at the sector rotation, it's an interesting development. Obviously, industrials benefiting. There was the weakness that we've had In Boeing, here let's really quickly go take a look at Boeing here. Boeing had a really bad week last week. It kind of culminated in that cluster that we saw. But since then, last couple of weeks, but since then, you can see the nice little jump. It had a really good week this week, and we see that reflected in the sector and how the sectors performed this week. Boeing kind of helping the XLI kind of finish stronger. Aside from that, you notice materials also up, but consumer discretionary and staples, both consumer stocks are doing really well. Financials rebounding too. Remember the yield curve discussions put a lot of pressure in that sector, so they rebounded. On the other end of the spectrum, interest rate sensitive areas, communication services, which is also these FANG stocks, and they gave up some of their recent gains, but also interest rate sensitive areas, they struggle. I mean, remember the yields kind of bounced up a little bit here. If I go back to long term and look at the 10-year yield, a little bit of a bounce up here at the end of the week with this long lower shadow, relatively long lower shadow. So we were very oversold on the 10-year yield. We had this discussion, I believe the last time I did this video, we had this discussion about how that can be pretty bullish, especially considering that we've now dropped to the Fed funds rate level to produce those clusters, 75 basis points from where we were when the Fed last raised rates. So there's potential for this to be a lower bound. Not that we'll jump up to new highs. There's a divergence that gets us up to, across a lot of oscillators, that can get us up to this 2.75 area. So very well could get a bounce up to 2.75 before we roll back over. The trend obviously is very bearish. So we're going to keep our eyes on that yield, but that's going to continue to pressure areas in the markets like real estate and utilities that have been doing very well during this pullback in yields, right? So they have potential to give up some of their gains. So if you take a look at, say, yields peaked on October the 3rd when the stock market peaked. So if you were to go back to go back to sector comparison, and then we'll do a custom time frame here back to that October 3rd time frame up till now. Let's do a daily chart. You can see how real estate and utilities, interest rate sensitive sectors, did very well. So other dividend type stocks within the staple sector also outperforming, and there's potential now that they can underperform, and some of these other like consumer stocks can do better as yields pull back a little bit. Excuse me, not pull back, bounce back up. Excuse me, bounce back up a little bit. One of those consumer stocks is actually looking relatively bullish here, is Advanced Auto Parts. You can see it's got dark green shading, dark green line on the daily chart. Not so much on the weekly chart, but the weekly chart is looking more bullish. Doesn't have the dark green shading yet, but we are back up above a rising moving average. So that's a positive sign, and we're closing above last week's high point. So a positive sign from that perspective. You look at its 3 green arrow charts, and you notice we got 3 green arrows and a rising moving average, just barely. But we also got a spike in volume today on AAP, so that's a good sign for that stock. And you look at the 3 green arrow chart, and when you break down those lines, you see the 8 and 17 are above the 30, the MACD's above 0, stochastics well above 50, so very bullish patterns. You look at the DMI as well here, and you see very bullish patterns on these DMI indicators too. A positive oscillator on that histogram, rising, the stochastic extreme, the positive sign crossing back above 25, the negative line below 20, so a rising ADX close to getting above there. And if you take a look at the Bollinger Bands for AAP, you can also see that we are clearing up above a strong level of volume, that as we get up above, there's a lot less volume, so there's opportunity for some movement here for this stock in the next little bit. Finally, take a look at the long-term view for AAP, and you see it never did produce a death cross during this period of weakness, and you can see the bounce that we're getting. So of course we can take a look at, don't want to be too aggressively bullish because there might be some weakness in the broader market here, but if I were to look at the 165 and sell the 160, now you notice they're not penny wide increments, they're relatively wide spreads, so It depends upon where you get filled in here. You have to kind of fiddle with this price. Remember, $1.16 on the $5 wide is kind of what you want to see. And considering how wide it is, it's going to be a little difficult to get out. So, your max loss in one contract's 377. You want to position size less. So, for example, if I normally position size for $1,000 of risk on any trade I make, then I probably don't want to do $1,000 here because of how wide the spreads are. I might not be able to get out at a decent pricing. So I might do 2 of these contracts. And if I do end up taking, if I do end up taking the $750 loss, that's not as bad as taking the full 1,000. And I can still get out of it. I just might not get good pricing when I get out of it. So I'm willing to lose. If I do 2 of them, I'd be willing to lose $250, essentially 246. And so as I get around that level, I might end up losing 350 if I try to get out because of the spread. But that's okay as long as I position size smaller than what I normally do. That's a much better loss than $1,000 and a much better loss than 750 if I couldn't get out at all. If you take a look at this on the Analyze tab, there's AAP. You can see there's pretty decent odds of success. And when you look at where that break even is, it's pretty much below last week's close here on the, you can see where it is on the short-term chart here. So there's where that break even is. Remember, I can let it go a little bit below the break even. So as long as we stay in the upper half of the chart on any kind of short-term weakness in the stock, we're okay, right? It's when we get back down into here, down to more like the, say if we're risking 123, or trying to make 123, we're willing to lose about 123. So that's going to be right in this 162.5 area. It's going to be right in this area. So we hold up above this area, great. If we don't, then we'll take that loss, right? Similar to what we're trying to make. All right, well, that wraps us up for today. As always, now I want to hear from you. Use that link that's popping out in the top right corner up there, or the link that's above the video on the blog. That will take you to our Market Outlook forums. Open up any new thread, reply to anybody else's thread, but you can post any questions or comments you have about what we discussed in today's video there, or any questions or comments on anything we didn't discuss in today's. That's the point of that forum, is to spark and continue the conversation in between videos among all market scholars that watch these videos day in and day out. So it's a good place to do that. As always, thank you very much for watching. Have a great rest of your weekend, everybody. Remember to subscribe, like, and comment on the video down below. Follow us on Twitter for more content and join our community on MarketScholars.com, as well as our Facebook group that we've created. Again, have a great one. We'll see you all next time.